Hello friends, what's up? Let us continue our lesson number 15. This is the fifth video of this particular lesson. In this video, we are going to study about the ARC, Asset Reconstruction Companies. Okay. So this terminology we heard in the previous video also, and it is with respect to the banking reforms in our country. That banking sector which has a lot of NPAs, and in order to clean the balance sheet of the banks, especially the public sector banks, asset reconstruction companies, they got legalized through the SARFAESI Act of 2002, and it could be established in India so that these companies could take over the bad loans or the bad assets of the banks, and then the banks could do their business. Okay. So basically, what is asset reconstruction company, we are going to see in this video. So asset reconstruction company is a specialized financial institution. Obviously it is an NBFC, okay, because it is working in the field of finance, but it is not a banking company. So it is a non-banking finance companies, NBFC. It is a specialized financial institution. It does some specialized work, okay, specialized task activity, and it's an NBFC. Guess which one? Okay, we have seen the classification of NBFC in the previous lessons. So it is basically a type of AMC, okay, asset management company, AMC, because it manages the assets. So it's a specialized financial institution that buys NPAs or bad assets from banks and financial institutions so that the latter can clean up their balance sheets. This we have already seen. Okay, that how asset reconstruction company, they will buy the bad assets of a bank so that the original balance sheet of that bank is cleaned. Okay, the bad loans is now off their balance sheet. They already sold it off. So asset reconstruction companies, ARCs, basically they are sponsored by government banks, okay, or government institutions like LIC, and also private players and banks. Okay, so an ARC can be formed by combined shareholding can be there by the public sector banks, that is SBI, and other public sector banks, or any other financial institutions of the government, basically like for example LIC, and also the private players like HDFC Bank and other private insurance companies maybe. So they can all combine together and they can form an ARC. Okay, so it's not necessary that only the government can form ARCs. ARCs can be formed by government banks, by private banks, by government institutions, private institutions, etc. However, as of now, they don't have any direct government holding, like for example the government of India or government of any state, okay, they don't hold any equity in the ARC. Okay, that we are going to see later. It can be a government bank but not directly the government of India. Okay, so please try to understand this difference. Now during 1997-98, India's NPA stood at about 14.4%. Okay, see, during this year, also, the year when the Narsimhan Committee was formed, India's NPA was 14.4%, double digit NPA. See, it is very high. And Narsimhan Committee recommended setting up the ARCs. Okay, it recommended that, see, in the first Narsimhan Committee, there was a Foundation for Asset Reconstruction Fund, ARF, through the budgetary allocation. But nothing was about any specialized financial institution, nothing was mentioned. But the Narsimhan 2 committee recommended that, there should be an ARC. Okay, there should be a specialized financial institution, which will be called ARCs, which will, manage all this bad debt and NP of the public sector banks. Then but see, in order to establish any institution, there should be a backing of law, right? There should be some legal backup. Okay, backing of law or rules and regulations should be in its favor, and there should be some legal basis. Otherwise people will challenge it as to what is the statutory provision behind it. So statutory provision that was given was the SARFAESI Act of 2002. Okay, so in SARFAESI Act of 2002, it is very clearly mentioned that ARCs can be formed, and these ARCs can be used to reconstruct the bad assets, because one of the provisions in SARFAESI is also about reconstruction of financial assets. This R stands for reconstruction of financial assets, right? So how this reconstruction will happen? Through the formation of ARC. So SARFAESI 2002 provided the legal basis for setting up of ARCs in India. It is important. See, it may come in an MCQ in the prelims exam that which act provided the legal basis for Asset Reconstruction Companies India. So it was SARFAESI Act 2002. Now, who will regulate? See, if there is an act, so there should be some government authority, some regulatory institution that should regulate and register these companies, ARCs. So ARCs are registered and regulated by RBI, Reserve Bank of India, under the SARFAESI Act. So the power is given to Reserve Bank of India to register and regulate the ARCs. This is again very important. Please try to remember these 2 points. Now ARCs can take over only the secured loans. Obviously, see, unsecured loans they cannot take over because they will not have power to do any reconstruction and recover those loans by securitizing the collateral, etc. because those loans are not secured. So obviously they will take up only the secured loans, right? Loans which are secured, given by the secured creditors, and they have to be classified as NPS. Okay, secured loans classified as NPS. ARCs can take over only those loans. Now, what are some of the examples of ARCs in India? Okay, so the first one we have already seen, it is the ARCIL, Asset Reconstruction Company India Limited. Okay, it is the first ARC of India, and it was jointly promoted by SBI, Punjab National Bank, and some private companies. Okay, so it is jointly promoted, jointly owned by public sector banks and also the private companies. Okay, it is not a purely government company. Please try to keep this in mind. Not a purely public sector bank company. Okay, it is also held by private companies. Then RSEC India Limited. Okay, so SREC India Limited, sorry. So again, this is another asset reconstruction company in our India. So again, it is held by public sector banks, LIC, Deutsche Bank. Okay, Deutsche Bank is a foreign bank, private bank. So they have jointly created this company RSEC. Okay. Then next is a Reliance ARCL, Reliance Asset Reconstruction Company. Obviously, it is a private company, the name itself suggests, and it is owned by Anil Ambani, not Mukesh Ambani. Okay, just keep this in mind. Then India SME ARC Limited. Okay, so India Small and Medium Enterprises Asset Reconstruction Company Limited. So again, it is owned by public sector banks and some public sector undertakings. Okay, so see, again the ownership is joint and very diversified. Then there is one company which is known as International ARC Private Limited. It is completely private. Okay, it is private ARC. The name itself says it is a private limited company. So as of today, there are total 28 ARCs in India. Okay, I have mentioned only the 5 names here. Okay, the 5 important names, but there are total 28 ARCs, and ARCs, they can be a small company, they can be a big company. Okay, it depends on what particular sector they handle. Some ARCs they will take loans only from bad loans only from the public sector banks. Some ARCs they will take up the bad loans of NBFC. So it depends on their business model. Now, how exactly the ARCs works, I'll tell you. For example, there is a bank. Okay, the bank has stressed assets. Okay, stressed assets basically means the NPAs. Okay, they are not strictly the same thing, but for the sake of now, you just consider that these banks have NPAs or stressed assets. Now these banks will sell these stressed assets to the ARC. ARC will buy it from the banks. At what price they will buy? They will buy at the net book value or at a discount. For example, this bank has 100 crore rupees of bad loans, okay, or stressed assets. Now these 100 crore rupees of banks, these are the assets of bank because it has to recover that amount from somebody. So now, because since it is an NPA, these banks will sell these loans. It will transfer these loans to the ARC. Okay, it will transfer to the balance sheet of the ARC. So this net book value, basically the value which is present in the accounts of the bank. Okay, net book value meaning which is present in the account, in the balance sheet. Okay, or at a discount. Now obviously ARC will not buy 100 crore of bad loan at 100 crore. So because they have to do the vasuli. Okay, if they are doing the vasuli from the people about this 100 crore, they will not obviously purchase this 100. So they will purchase it at a discount. So it is known as haircuts. Okay, it is known as haircuts. So they will purchase it at a haircut or discount. So they will say that we will only pay you 95 crore. Okay, 5 crore, 5% discount we will take here. So bank will also say, okay, anyways we are not going to get this 100 crore, and so let us sell it at 95 crore. So they will sell it at 95 crores to this ARC. Again, when they are purchasing this stressed asset or NPA from the bank, they are not giving 100% money to the bank at once. So what they will do is 15% cash they will immediately give. Okay, so of this 95 crore, 15% they will give in cash, and 85% they will give in the form of government security deposits. Okay, so they will give in the form of government security, or they will give in the form of some bank, other bank guarantees or those kind of things. So they don't have to give 100% cash to the banks. So they will give 15% cash, and remaining 85% they can give in the form of government securities. Now, why do they invest in government securities? Because obviously they will earn some return on the GSECs also. So they will not use all their cash just to give to the banks. They will invest in some of the government securities, they will get some returns out of it, and then they can pledge those government securities 85% to the bank. So this is how the model runs. Now, ARC should have minimum net owned fund of 100 crore rupees. This is a regulation of RBI that in order to set up an ARC, you should have a minimum net owned fund. Okay, net owned capital of 100 crore and minimum CAR, that is the capital adequacy ratio of 15% of risk weighted asset. So CAR we already know what it is, right? So this is just the regulation about the ARCs. Now there is something called as bad bank also. Okay, you must have heard this name, bad bank. So now what is a difference between a bad bank and an ARC? Bad bank is also in the business of reconstruction of bad assets. Okay, reconstruction of bad assets. But what exactly is the difference between a bad bank and an ARC? Okay, so bad bank is also an ARC. It is also an asset reconstruction company. Its prime business is asset reconstruction only, but it is completely under government control. Okay, so as of now it is completely under the government control. So as I have told you, in asset reconstruction company, the ownership is by the public sector banks or public sector undertakings or private players, right? It can be a government company, but it is not directly government of India. Okay, it is not directly government, but in bad bank it is directly government of India. Okay, the government of India directly owns the bad bank. So that is the concept. In 2021 budget, our finance minister announced the establishment of the first bad bank of India. Okay, the first bad bank of India was announced, and its name was National Asset Reconstruction Company Limited, NARCL, to be owned by government of India. Okay, so this will be our first bad bank. Now, individual banks sell their stressed assets to asset reconstruction companies, and this process gets stuck because ARCs normally seek large discount on loans. See, these ARCs are also, kind of private companies only. They are, they have profit motive. They will try to ask for large discounts. For example, in the above example, this 100 crore loan, maybe they will ask only 80 crore. So they are asking 20% discount here. So maybe because of this negotiation, what happens, most of the times the banks are not able to actually, get the benefit of these ARCs. Okay, because they are asking, randomly anything, any discount. They will say, we will only pay you 80 crore and, we'll only buy it at 70 crore and we want 30% discount and that kind of thing. So that is a need for, a bad bank, for government intervention. Okay, because see, you will ask a question, if there are ARCs, what is the need for government to set up a bad bank? So the need is because, these banks are not able to properly negotiate with ARC, because these ARCs are asking discount randomly. They are saying we want 20%, 30% discount, those kind of things. So very large discount, very deep discounts they're asking. So that is then what happens, valuations also come as a problem. So for example, if there is a loan, so banks are saying that this loan is 100 crore rupees loan, but we don't know how to value that loan, because asset reconstruction company will say that, say for example, there are different components of this loan, so by different valuation methods, maybe the valuation of this loan will be only 98 crore as per the ARCs. Okay, so valuations come as a problem, and what is the amount at which the loan has to be settled, that comes as a problem. And with the proposed bad banks, this valuation issue is unlikely, as it is a government initiative. Okay, so because it is a government initiative, there is some social factor to it, not just the profit motive. So maybe these problems will not come. That is the reason why bad bank is set up. and also for handling big amounts. So you see, ARCs ultimately they are private companies, they will have their own financial limitations. What if they know there are very big amounts involved? For example, if an ARC, it can purchase only loan of say up to 5 crore rupees, or say loan up to 25 crore rupees, but because it is beyond their capacity to go beyond this. But what if there are huge amounts, like say for example 1,000 crore of loans, and there is no private ARC or no any other company which is present in India to actually purchase this level of bad loans. So to handle big amounts, normal ARCs can't participate due to their incapacity. So that is also one of the reason why bad banks is established by the government. Now let us proceed further and study about another very important government institution, which is the Banks Board Bureau. Okay, BBB. Okay, Banks Board Bureau. So what is the genesis of Banks Board Bureau? Why it was formed? Again, the genesis was rising NPAs in public sector banks. Okay, so NPA meaning non-performing assets in public sector banks was on a rise. Okay, and there was a committee set up in 2014 by the government, which was known as PJ Nayak Committee. And PJ Nayak Committee mentioned the need to review governance of board of PSBs. It said that these NPAs, one of the reason of NPA is bad governance in the public sector banks, especially in the board of governors. Okay, BOGs. So especially the people who are heading the banks, the people who are who are the chairman of the board of governor, and who are actually taking the policy decisions of the bank, basically because of their bad governance and their indiscipline, these NPAs are occurring. So and PJ Nayak Committee said that we need to review the governance of board of public sector banks. And as part of Indradhanush mission, okay, to revamp the PSB. So he had recommended, so there was a recommendation which was known as Indradhanush mission. Okay, Indradhanush because there are 7 colors in Indradhanush meaning rainbow. Okay, for non-Hindi speakers, I'll tell you. Indradhanush means rainbow. So in rainbow, there are 7 colors. So it was a 7-point strategy. There were 7 points mentioned in that: how to reform our banking sector, how to reduce our NPAs in the public sector bank. So it was a 7-point strategy, and one of these strategies in this 7-point strategy was this Banks Board Bureau. Okay. Now what will be the composition of Bank Board Bureau? Okay, who will be there in the bank? Let us understand what is Bank Board Bureau, who all are there. So it is basically a not-for-profit autonomous government body. Okay, it functions autonomously. Okay, it is a government body, but there is an autonomy given to it, and it is a not-for-profit company. It is headquartered in Mumbai. It replaced earlier appointment board of government. Okay, so previously there was an appointment board of governor which used to appoint the chairman and board of governor members, board of director members of the public sector banks. Okay, so now it got replaced by the Banks Board Bureau. It comprises, okay, who all are the members of the Bank Board Bureau? There is one chairman. Okay, and chairman is usually a retired bureaucrat. Okay, usually a retired bureaucrat. For example, our ex-CAG, Vinod Rai, he was the first chairman of the Bank Board Bureau. Okay, so just keep in mind that RBI governor is not the chairman of BBB. Okay, I'll write it here. RBI governor is not the chairman of BBB. Okay. This is very important to understand. So it is usually a retired bureaucrat, government appoints them. Then there is one, ex officio members, 3 ex officio members. One is Secretary, Department of Public Enterprises, then Secretary, Department of Financial Services. These both are in Ministry of, this is in Ministry of Finance. And then Deputy Governor of RBI, one of the Deputy Governors of RBI. These 3 are the ex officio members. And then there are 5 expert members, of which 2 are from private sector. Okay, this is the composition. So there are total 9 members. Vinod Rai ex-CAG was the first chairman of BBB. It was established on 1st April 2016. Now what are the functions of BBB? So functions of BBB is that it has an advisory role. Okay, it gives advice to the government. On what basis? To recommend the public sector banks personnel, personnel like non-executive chairman, full-time directors, etc. Okay, basically people who are heading the public sector banks. to recommend directors in government owned insurance companies also. Okay, not just the public sector banks but also the insurance company. Then provide assistance to public sector banks to restructure business strategies, especially to deal with NPAs. How to deal with NPAs? They will give advice to the public sector banks, okay, to restructure their business strategies. Recommendations on mergers with other banks. Okay, so it gives some business strategy advices also. Then it provides assistance to public sector banks for developing capital raising plans. Okay, how to raise capital, how to issue bonds, how to raise the tier 1 capital, tier 2 capital, etc. And also advise government on evolving suitable training and development program for managerial persons in the public sector banks. So basically, as you can understand, it has a advisory role. Okay, it advises government, it prescribes to the government what should be done, who should be appointed as the chairman, and then finally government takes the decision. Now let us come to the next institute, that is Financial Services Institutions Bureau, FSIB. Okay, so friends, whatever we discussed about Banks Board Bureau, actually FSIB has replaced the Banks Board Bureau, BBB, in 2022 last year. So why it got replaced, that we'll discuss in just a few minutes. But let us first understand what is Financial Services Institutions Bureau. It has replaced the Banks Board Bureau in 2022, that is very recently. And it is a government body set up under the Department of Financial Services under Ministry of Finance. Okay, so it's a government body and set up under this department. Now the members are more or less the same as BBB. It has one chairman, and Mr. Bhanu Pratap Sharma, who was the chairman of BBB just before the FSIB was formed, continue to be the chairman of FSIB also. He has been given appointment for 2 years, fresh appointment for 2 years for being the chairman of FSIB. Then Secretary DFS, Department of Financial Service, will be the ex officio member. Chairman IRDI, this is a new member added. Then Deputy Governor RBI, it was there in BBB also. These are the 3 ex officio members. And then there are 3 part-time experts from the banking sector and 3 part-time experts from the insurance sector. So this is the composition. Now, what is the responsibilities of the FSIB? It is more or less the same as BBB. So, basically to recommend the appointments of full-time directors and non-executive chairman of state-run financial institutions, including the public sector banks. Okay, so financial institutions meaning it includes, institutions other than banks also. Okay, so there are all India financial institutions, like for example NABARD, SIDBI, NHB. Okay, so those are also included here. So it has broadened the basically umbrella of the organizations which will be covered under it. Okay, so and along with that, it can issue guidelines. Okay, it cannot recommend people to be the general manager or be the director of the public sector general insurance company, but it can issue guidelines. That is, on what basis, on what guidelines, on what criteria they should be selected. Okay, who? The general managers and the directors of the public sector insurance companies. One thing you need to understand, that general managers are subordinate or they are below the directors. Okay, so a directors get, the general manager get promoted to being the director of the organization. So this is just for your knowledge. Okay, so they can issue guidelines for selection of both general managers as well as the directors of public sector general insurance companies. Then again, to formulate and advise business strategies for state-run banks, that is public sector banks, and help them in their fundraising plans. It is same as BBB. Okay. Now, why was BBB replaced? It was so basically what happened in 2021, Delhi High Court, it declared the BBB an incompetent authority to recommend general manager or director to the insurance companies, basically. Because what happened, there was one general manager in the national insurance company, and he challenged appointment of a person junior to him as the director of the BBB. So Banks Board Bureau, what it did, it recommended a junior person to become the director from general manager, okay, of national insurance company. So another person who was senior to him, he challenged that decision in Delhi High Court, and then Delhi High Court struck down that decision and it declared that BBB, okay, Bank Board Bureau, is not the competent authority to recommend appointments of general manager and directors to the insurance company. Okay, so because of that, what happened, that 10 to 11 directors of insurance state run insurance companies, they had to vacate their office due to this decision. Okay, who were appointed and recommended by the banks, board bureau, they had to vacate the office because of this decision. Okay, so in a way, BBB got declared as incompetent to function. So that is why the appointment committee of cabinet, which is headed by the prime minister, okay, they decided that let us dissolve BBB and let us come up with a new institution, financial service institution board. Okay, so they passed a resolution and they formed a FSIB and gave it some powers to do it. Okay, so basically this is about the FSIB, a new body which replaced the BBB. So please keep in mind that although we have studied BBB for our knowledge in this video, BBB no longer exists and it has been replaced by FSIB. Thank you.